Howdy, Jacob here. Today we're looking at Altria Group, ticker symbol MO. It's in the tobacco industry. So similar like company to British American Tobacco that we looked at maybe a month or two ago. Company was founded in 1822, so it's been around for a little bit, I guess. It's one of those sin stocks, so keep that in mind as we go through some of the assumptions. I might, uh, for some cases, I'll put premiums. In other cases, I'll be a little bit more conservative, and this is one of those cases. 71 billion on the market cap, 94 billion enterprise value, 9% dividend yield. Wow, that's crazy. That's pretty crazy. So $3.68 on their dividend per share. It looks like pretty good return on invested capital. Usually pretty good, but I presume almost all their money that they're making is going out in dividends. Let's see. So they actually made some devastations in 2021 and 2022. Looks like their 5-year average is right around $8 billion. They're paying out 6.7 billion in dividends. I mean, they can't afford that. They can afford it. They've been buying back common stock, paying down debt, which is good for them. Let's see how much they have. 25 billion in long-term debt, and we said roughly 8 billion on a 5-year average free cash flow. So maybe four times. Three, little over three times, little over 3 years on their average free cash flow. But they are paying out a huge dividends. So they might, if I'm a lender, I mean, three times 5-year average is pretty reasonable. Uh, so I don't see an initial concern there. It is a good amount of debt, and with them paying out such a high dividend, their ability to pay down that debt is kind of minimal. But um, fine with that for now. I think I'm ready to get to setting some assumptions here. Pretty flat business. I might say no growth, 0% revenue growth, 9 on the P and price to free cash flow because I'm just being a little bit more conservative due to it being a sin stock in the tobacco industry. Um, let's look at some earnings margins here. Have been all over the place. Free cash flow has been a bit more consistent though. So maybe 37% free cash flow margin, 30% earnings margin, 1% buyback of shares. I think the dividend, I mean, it looks like they have historically increased their dividend pretty consistently. And I mean, they don't have a whole lot of growth in other areas, so that's probably why they're paying out such a high dividend. But to me, I would want the company to probably keep the dividend as is at like 6.7 billion, and then as they buy back shares that are hopefully cheap, then that aggregate payout will decrease down a bit due to there being less shares outstanding. So I think for now I'm fine with them having their dividend as is. I'm not going to increase it anymore because I want them to focus on buying back shares that are hopefully cheap and then paying down some of that debt. So this gets us to a price that the company stock price would need to fall 26% before we get a 15% return. Given these assumptions, uh, fine with that. I think if you're comfortable owning a company in the tobacco industry, I think this dividend is very solid, and I would definitely put it on your list of companies to possibly invest in if you are comfortable with that. If you're not, then super easy to just say Ixnay on the dictionary. We're not looking at it. So keep that in mind when if you want to invest in a company that is in the tobacco industry, which is historically known to be a sin stock. But for now, 26% fall before a 15% return. I think I'm comfortable with these assumptions right now, and I'm just going to be sitting back waiting. So I hope everyone has a great rest of their day. Thank you.